Welcome, everyone. We're going to kick off. Thank you, everyone, for coming. So today's webinar is around, I'm just trying to see one thing. Yeah, if I can, there we go. Is around towards net zero in insurance. What regulatory environment do we need? Next slide, Ross. Right. So what I'll do is I'll just give you a brief outline of Icebreaker 1 and our vision and missions, and it's to help people use data to create impact. The vision is make data work harder to deliver net zero, and our mission is to empower decision makers to mandate, measure, and act upon the data flows that enable net zero. Next slide. So a project within Icebreaker 1 is SERI, and that stands for the Standard for Environment, Risk and Insurance. It's a UKRI and climate kick funded program, bringing partner organizations and leading institutions to bridge the gap between finance and climate change. So what we're trying to do is essentially figure out how to make insurance net zero. And there's method to that, which we'll get into. Next slide. So one of the ways that we've tried to break this down is a case study. So in 2020, the SERI program looked at climate-ready financial projects to enable insurers to invest, in demonstrably net zero financial products and services. And then this year, we've been looking at a climate-ready building passport, and it's a concept to help. It's a use case basically to help us figure out how we can use a shared data infrastructure to get to a net zero. To get to net zero outcomes using insurance. And the use case will also be used to identify data requirements and stakeholders necessary to shape the governance framework, which is what we're trying to do and what we're all here to do today for sharing data within the insurance sector. Next slide. So what is a climate-ready building passport? Well, it's a digital folder containing a vast amount of information on a particular commercial building, and a climate-ready passport could enable stakeholders to incentivize climate-ready behaviors, access historical and real-time reporting to enhance risk analysis. So there's a whole other side to it. That's obviously you've got the climate change, but you've also got the idea that there's a benefit to insurers about enhancing risk analysis. Discover and share appropriate data in a secure environment, and share data underpinned by robust standards. So obviously what we want to do is figure out what should be open data, what should be shared data, what should be closed data. That's all very important. Those definitions are obviously important to make sure that everybody feels like it's underpinned by standards that everybody feels comfortable with. Next slide. So today's questions, these are my general sort of overarching macro questions to keep in mind throughout. So insurers want to move to net zero for a variety of reasons. How might the building passport help? The second one is, while moving to net zero is an aim of the insurance sector as a whole, making the first crucial steps will be difficult without a regulatory push. What should the regulatory environment look like over the next 2 to 3 years? So just to sort of slightly elaborate on that one, obviously what I want to try and do is recommend something that is light touch enough so that it's not overbearing or doesn't have contradictory elements, which could weaken it. But also by the same token, I want it to have teeth and be effective. So what's the thing that we could push to make that happen? And the third one is, could this regulatory environment help the government achieve its 10-point plan for green growth? So one of the things we obviously want to try and do is fit this into the current government's agenda as it stands. And obviously they've got a 10-point plan for green growth. So what is there in here that could fit into the 10-point plan? Next slide. So my more in-depth sort of granular questions, and these are around the work that we've already done on this, is so the CMA did a market study of the banking sector, which led to the adoption of open banking being a great sort of comparison in some ways to what we're trying to do here. Something that, again, you had a slight regulatory push, created a big difference within that sector. Could the CMA do something similar in the insurance sector? If not, what could the FCA or PRA do in this regard? So basically what we're asking there is, who's the regulator that we should be focusing on, and how? What would be the thing to go to them with? 2 is turning up the dial on EPC ratings, part of the answer. So for rented commercial properties, at the moment, your EPC rating has to be E or above. And that's going to become there's going to be even more stringent requirements on that come 2023. Would dialing it up to D, would that be a good thing, bad thing? Would that have an effect? How much of an effect would that have, do people think? The third one is, does climate change constitute a systemic risk to insurance companies enough to worry ratings agencies? So what we're looking at is, in talking to insurance companies, what we've sometimes come across is, well, yes, we'll move when we feel the risk is big enough to make the big move. The problem being is, could the risk become so huge to insurance companies that it becomes a systemic risk? In other words, is there a point at which insurance companies are so overexposed, something big happens, and the government has to bail them out, essentially. So that's where we bring in the ratings agencies. And finally, should we make TCFD disclosures mandatory on a more regular basis? So at the moment, we're looking at making them annual in terms of disclosure. Would making them quarterly, would that be a good idea? Would that make a big difference? Would that be difficult in some ways to bring in? So those are my those are my questions, and that's my presentation. As I say, I've tried to keep it tight. I know there was a lot in there that was it was information heavy. I tried to, at least I tried to make it that way, mostly because we've only got an hour, and I really want to open this up for conversation and dig into this as much as possible with the time that we have. So what I'm going to do now is, if we could, we're going to do a couple of polls, just while everybody digests that a little bit, while particularly the selected speakers digest that a bit. So Anne, if we could have the first poll, that would be great. I think possibly wrong. Oh no, okay, fine. So this is just about which describes your work. So this is just letting us know, the people who are in attendance, what do you do? So I will give you a chance to do that over the next minute or so. And yeah, as I say, hopefully we will try and answer the broader questions and get some meat on the more in-depth ones as well as we go. Yeah. So I'm going to give everybody another 30 seconds, if they could do their thing before we end the poll. Right. And thank you all for coming today. I really look forward to a great conversation on this. Right. So I'm going to give you another 5 seconds if anybody's rushing to do it, and then I'm going to end it. Right, end that poll. Great, perfect. So thank you very much for that. That's very helpful information to understand. Obviously, something else was high in the poll, so that's interesting in and of itself. Anne, could you launch the second one, please? So we've got the first poll up. If you could launch the second poll.
Yes, sir. I'm doing it.
Yes, please, as Gavin says, please comment on what the something else is. If you could put those in the comments, we'd really love to hear what that something else is. It's just really interesting for us to understand, who's got the interest in this, who's taking part. It'd just be really interesting for us to have that information. And also, just to let you know, I'm going to make this quite open today. We've got some selected speakers, people I briefed beforehand, who will be speaking at the top. But right from the get-go, if you have any thoughts, questions, anything you want to put into the chat, you can start doing so right away, because I want to keep this very conversational. We're really looking for as many good thoughts as we can pack into the hour. So anybody who, just right off the top, if you've got any questions or thoughts, by all means, please put them in the chat. That'd be great. And as Gavin says, yes, there are no wrong questions. Anything that you might think seems really obvious, or oh well, everybody has an answer on that. It's very possible that it's something no one else has thought about. So by all means, I encourage you to think as outside the box as you can. Right. Okay, I'm going to give you 5 more seconds, and then we're going to close this down. Great. Thank you very much for participating, guys. I really appreciate that. And so the poll results: what is your biggest challenge around data sharing and data access? And we've got a real mix, which is interesting. Lack of clear data. I think the winner is probably lack of regulatory standards, which is really good for what we're doing here today, because obviously what we're trying to do is get to the bottom of the regulatory questions. So that's good to hear that we're on the right track certainly in terms of what we've picked as our topic. I'm going to bring in Richard Holmes. Richard, if you could just, and I'd say this for everybody who's speaking, if you can just very, very briefly introduce yourself before you get into it. And Richard, just anything on the three macro questions, the four granular questions that you want to dive into, go ahead.
Sure. Okay. Well, good morning, everyone. So my history is I used to be a senior regulator, prudential regulator in the United Kingdom. And since 2003, I have been on the boards largely as chairman of Lloyd's insurance brokers and Lloyd's underwriters. And at the moment it happens to be insurance broking rather than underwriting. So some off the cuff, although Nick and I have talked about this before, some off the cuff thoughts about this. And how would you break into the market with these ideas? And there are, I believe in challenging. So these are constructive challenges. I'm not pouring cold water, because the insurance industry, particularly general insurance, but all forms of insurance, thrive on data. Using data to price risk is what we do. But it's a competitive environment, and it needs to be competitive. It's a government objective that it should be sufficiently competitive. And breaking into competitive markets with new ideas is frequently very difficult, as certain football clubs discovered recently. It's quite hard to do. And I think a number of issues here. How might the passport help to get to net zero? There's a bit of an assumption in the slide, at any rate, that the insurance industry wants to get to net zero. I'm sure individuals do, but I'm not sure that corporations particularly want to do that. It will be in their social responsibility statements, sure, but actually the prime motive is to make a bit of money sometimes. So I think that needs to be teased out a bit more. Likewise, the regulatory environment, there is already a push, particularly by the prudential regulators, to get financial institutions to address climate change. But they also have a number of conflicting objectives. And as I say, one of them is to promote competition. So the idea of shared data infrastructure and open data is something that will be viewed with considerable caution if its effect was to reduce competition. And that competition aspect needs to be teased out, it seems to me. The open banking comparison is an interesting example. There, the point is lack of competition. Because of consumer behavior, consumers don't shop around. You'll tend to get sludge tactics. And open banking is quite a different concept, really. It's trying to force the banks to enable their customers to shop around. By contrast, commercial insurance, which is largely what we're talking about here, is a highly competitive marketplace and doesn't really need that regulatory push. So the regulatory push needs to be quite different. It would need to come not from trying to sort out conduct issues amongst banks. It would be about the environmental agenda being so pressing that the insurance industry would have to do things differently. And I think you'd have to demonstrate that link. Lastly, I'm not going to address all 7, I'm only addressing 5. On the climate change being a systemic risk to the industry, well, it certainly is. And that is where I think people are energized to understand better what risk they're on for, because after all, data is for risk pricing. As to whether the rating agencies would ever down rates on this issue alone, I think the point to bear in mind is that the relationship between insurers and rating agencies is dynamic. Most insurers will have a reinsurance security committee, which will have standards, and those standards are based on ratings of who reinsures you. And if your rating slips, you're in big trouble. So insurance companies and reinsurance companies are talking to their rating agencies at regular intervals. And if they see their rate in slipping, then they'll do something about it, classically by putting more capital in or by changing the sorts of risks they accept. So I wouldn't see the systemic risk leading to systemic risk agency downgradings. It would be rather more subtle than that. So for all these reasons, based on current knowledge of what you're proposing, I think the area here lies in clarifying. The issues are around clarifying what you're trying to do and seeing the government as the place to go rather than the insurance industry. But that's not off the cuff view of it.
Right. Okay. Well, thank you very much, Richard. Just because you spoke a little bit about ratings agencies there, I'm going to bring in Stuart. Stuart, can you come in and just on the point about ratings, ratings agencies and their role, as it were, in all of this, as sort of de facto regulators.
Sure. Yeah. Morning, everybody. I don't know if you've got my details, but I'm ex-S&P, ex-AM Best, and nowadays our gamekeeper turned poacher. So we work with insurers and reinsurers trying to persuade our former colleagues of our clients' financial health. Rating agencies have very extensively defined quantitative and qualitative methodologies for what they do. Somewhat contrary to popular belief, goes a long way beyond capital adequacy, though capital adequacy is clearly central. There's lots of component parts to it. S&P in particular have published on, in fact, they are currently publishing a RFC, a request for comment, on the next phase in putting ESG into their methodology, their credit rating methodology. S&P do a lot of work separately on ESG. They have a related but different service around ESG assessments that they publish. This is all on their website, but I'm sure I could find people links to these things if they're interested. And they're sort of taking component parts of that and bringing it into their credit rating methodology, basically. As of now, they very fortunately have just produced a little piece on this. I just got this morning from somebody there. As of today, ESG impacts 7% of insurance ratings globally, of which 3% derives from the E. And that is almost entirely due to what they call physical risk exposure, which is catastrophe risk exposure, wildfires, that kind of thing. So at the moment, it's pretty modest impact, idiosyncratic impact. 3% of their ratings have had an impact from the E within ESG. However, a couple of things. One is that a fundamental part of S&P's methodology, indeed all the major agencies' methodology in slightly different flavors, is what they call competitive position. This is the assessment of the intrinsic business strength or weakness of the insurer or reinsurer, and therefore its likely ability to produce sustainable future profits. And they care about that because they see that as the principal leading indicator of future strong balance sheets, which is the thing they're really trying to rate to. How solvent will you be in 10 years' time when a claim comes? As of today, competitive position, I'm being told, has not ever been affected enough by an environmental related concern to have had a change, but they certainly accept the principle that it could be. And to give you an illustration where this might tie back to Richard's point about government rather than industry, and that where the rating agencies might play a role in that, they are very exercised about the controversies around contingent business interruption for those insurers, particularly insurers, who have been high profile in that, as it relates to the brand and customer relationship part of their competitive position analysis within the credit rating. So there is this very overt link within the methodology about how you are perceived by the marketplace, particularly in anything that is reputation sensitive. Commercial lines, one could argue, is a little bit less reputation sensitive than personal lines, or in certain sorts of ways, but nonetheless probably is. So they'll certainly be keeping an eye on that. They also have another part of their analysis, which is very specifically focused on any form of regulatory or accounting or legal infraction. So if there was a regulatory step that insurers were supposed to either comply with or ensure that their clients, the commercial insured, has to comply with, of substance, of significance, then they would definitely be checking that the insurers are doing that. And that would be a negative component part of any insurer's rating if they were not doing that. So that's a possibility too. But at the moment, the main action in the actual ratings is where you probably think it is. It's that group of their rated universe whose catastrophe risk exposure has increased by enough, or their ability to, the degree of ability to control it has decreased by enough to cause a rating action. And that's basically it so far. And that's 3% of their global insurance rating universe.
Right. Thank you very much, Stuart. I'm going to bring in Bronwyn here just to comment on anything that has been said by Richard and Stuart, but also just I'm interested as well around Tcfd reporting as well, and obviously anything from the from the list of questions would be great. Yeah.
That's okay. Would we be able to go back to the list of questions?
Sure. What
Yeah.
I can do is let's have a look. See here. Right. So
double check.
Yeah.
I mean, I think it's good to recognise the sort of evolution in this space. I think, I mean, when a couple of years ago, it was very much seen that, say, S&P or Moody's and that like were very much sort of pseudo regulators because they were putting together the key criteria of where we were measuring climate readiness and performance against ESG. So I think they were definitely some of the first movers in the space to be able to quantify how firms were progressing and how it would actually impact on their balance sheets. So I think definitely need to kind of recognise that position there and that really important piece of linking it back to the balance sheet and the credit worthiness and what you might be looking for if you're an insurer in that sort of credit insurance space and that kind of business continuity. Those numbers would be really critical to your understanding and confidence in the work of the business that you're insuring. I think sort of then connecting across to more of the resilience and what's happening in the climate ready building space, then you also need to see the importance of the regulator to set the minimum standards, that there are a lot of leaders in insurance who are doing some really great work, but they're actually quite small in number. And there's a definite kind of, we often term it like a peloton. There is sort of the mass. And that is often more regulatory driven. They're looking at how to respond. You'll sort of see still in like industry surveys of most of finance that there is sort of limited sort of first steps. And they're usually coming more from that regulatory space of we've been asked to do something by the PRA, we've been asked to do something by the CFA, we've been asked to do something by our investors, and it's much more of an external pressure for the majority. Is sort of the sense I'm getting from surveys across the market, like done by GARP and things like, and similar. So then in terms of how does that translate into TCFD disclosures, I think the push for mandatory disclosures from the PRA is sort of and definitely being sort of seen as a leader here, as you can tell from COP26 and the G7, that they have a lot of pressure at the moment. And I think their stance is putting more global pressure out to others. And I think there needs to be, I think for most firms, if you're looking at having different rules in every jurisdiction, it is quite problematic. So you're, I think, looking more for a similar standards to what you would be seeing in the accounting space. So you're looking for something that's much more understandable across the board so that you can aggregate your business and you can replicate processes and be able to work in a much more sort of efficient and effective then environment that is also able to inform business decisions. So I think for the TCFD disclosure, I do think regulation would be quite helpful. It would clarify what's happening.
Okay, great. Thank you very much, Bronwyn. Ted, I'm going to bring you in just mostly on if we're talking about government rather than industry, if we're going to just focus on that. So I know you've looked at the 10-point plan a little bit. Where do you think that fits in terms of all this? Is there any places in the 10-point plan that you think offer kind of ins for net zero insurance, basically, and the building passport?
Yeah, thanks, Nick. Just give background to the rest of the group. I'm a senior researcher at Onward, a think tank in Westminster, so mainly look at this through the sort of guise of politics, really. And yeah, I mean, I might just turning back before we sort of get into the 10-point plan. I mean, I sort of see the challenges for insurers are sort of. I'm no expert in this, so I'm just sort of scoping it out. Really, is I suppose the underwriting portfolio. You know, how you can drive change through the customer base and adapt the product and service offerings. And then you've got the sort of investment portfolio, the internal emissions, and then what we're talking about here today, which is the regulatory and reporting. So like there's a number of sort of facets to this debate. And I think if you look at what's actually an interesting bit of legislation is the Modern Slavery Act. That actually, if you look at how financial institutions have been made to report on it, there's been a complete gap in legislation reality. Like actually, if you look at these big banks under the Modern Slavery Act, they're actually just having to look at their cleaning staff and you know, who they actually employ in the building, not all the investments that they are in. So I think there's a sort of growing political pressure at the moment on both sort of that, but also on how you relate that kind of legislation to the climate debate and how you try and sort of embed ESG really properly in financial services. And I think, you know, just looking more broadly on financial services, I think the change is definitely coming, and lots of sort of movements in government, and also Mark Carney's work on this more broadly is sort of very well received, and I think that you can see a lot of that sort of coming in the near future. And then just getting onto your point, Nick, on the 10-point plan. I mean, that is the thing with the insurance industry, is it cuts across all sectors, and it really is like it's a really sort of interesting element to this debate, because actually it really does. But like you could pick any one of those 10-point plans. Things. It could be carbon capture, it could be EVs, it could be hydrogen, and you know, the insurance industry will be like a crucial element to that. And I think there's both opportunities and huge challenges. And I think looking at your presentation this morning, to me, the sort of the most important aspect of it is this data sharing element. And I think without sort of a proper you know, a proper movement into a more open insurance industry where different insurers can see data from their competitors, I think it's difficult to see how climate risk can be sort of properly embedded. But yeah, I mean, just with regards to 10-point plan, I think you could really filter the insurance into any of those points, as it really does cut across all of them.
Great. Thanks, Ted. I'm going to bring in Ben here on two things. One about data sharing within the insurance industry, how that could be encouraged, roadblocks, you know, anything on that. Also, just anything you have to say about the EPC ratings question. If you have anything to say on that, Ben, I'd be really interested. And then obviously, well, anything else that we've already that's in the questions.
Yeah, thanks, Nick. So for people who don't know me, I'm Ben Howarth. I'm Manager for Climate Change Policy at the ABI, so the Association of British Insurers, represent the general insurance industry and the long-term savings industry. I was just going to touch on the building passport itself, maybe before I go on to data.
Sure. Because
I think it's an idea that, as far as I understand it, has quite a lot of potential. But one of the points I would emphasise is it's unlikely the insurance industry is going to hold all of the relevant data that you would need to put something like that together. I think it's worth thinking about this, and I suppose this comes to the data point in the context of the government's wider smart data agenda. You know, what data do other sectors hold that could inform this? Insurance might hold some of it. But some of the specifics around buildings, I think it's really important to distinguish between the different risks, and where you're involving insurance, really linking back to what is the purpose of the product customers buy. So, you know, in a climate change context and buildings, you will have the sort of adaptation risks, which perhaps links to EPC ratings, where you've got a huge challenge facing society to kind of retrofit and remodel buildings to become more energy efficient. Now, the costs of that and the economics of that strike me as being, you know, a really big challenge, and not one that is uniquely within the scope of the insurance industry. And I think occasionally I've seen people say, oh, could insurance premiums incentivize people to do this? And I just think the numbers don't work. You know, the amount you would need to spend as a consumer to upgrade your building is unlikely to generate you any kind of saving on your insurance. So the question would have to be, what is the impact of energy efficiency on the risk of claims? So I think that's quite a big leap for insurance, actually. Energy efficiency and risk of claim, not necessarily directly bedfellows. There are some other aspects of this, though, that I think obviously do impact risk of claim, particularly once you get to the resilience side. You know, flooding being the biggest risk in the UK to building resilience, where you've got both kind of adaptation measures that you could take to make yourself more resilient, but also you've got the need to do something about climate change in order to stop the claims or to reduce the overall number of floods. So there is a sort of direct link to insurance, but it's maybe some aspects of this don't directly flow through to the specific products customers buy. So I think that's really important. And I think to involve the insurance sector effectively and to make them part of this, you need to make sure it really does link to the products and has a real distinct purpose that customers will understand. So that'll be my first point. On data sharing specifically, it's interesting the kind of idea around the CMA. I mean, I think, like other speakers, I don't see there being a competition issue at the moment that would lead to CMA intervention. The SCA are very actively looking at open finance. And, you know, the idea is extending some of the concepts of open banking out to other parts of the financial sector. They are definitely, and I think this is already a decision that's been taken, looking at it with a different angle. You know, I think they recognise there's not a market access competition issue here. You know, there's not a restriction around data that stops new entrants coming into the insurance market or some of the other bits of financial services. However, there might be some benefits to open finance. So I think they'll look at open finance with a lens that's a bit different to open banking. This kind of data sharing could be part of open finance, so it could be sort of led by the regulators. But I think where the FCA are looking at open finance is probably more around, you know, developing new consumer services and bringing new entrants into the market. So I would say with this, actually, the insurance sector's got quite a good track record where there's data sharing that's clearly in the wider interest and there's a clear purpose for it. You know, floodery has been driven by a significant amount of industry data sharing. The motor insurance industry has the MIB, which shares all kinds of policy information in order to prevent uninsured driving, tackle fraud. So the industry's got a reasonably good track record on data sharing. This feels like a more challenging data job because I think to link it to buildings, as I said before, you need data from quite a wide range of other sectors. But I feel that the main argument on data is to demonstrate a use case that the data would offer benefit rather than feeling that it needs to be something regulators mandate. I think there's probably going to be a strong enough use case, provided it's done in a collaborative way and that, you know, the insurers get benefits from it as well. I think there's a good enough use case that you could probably, with the right incentives and the right structure and understanding the costs, etc., you could probably get insurers involved. I don't think you'd need regulators to step in and force them to do it. So that was my other point. I just want to make one brief point on regulation, wider point on regulation as well, which is just to emphasize that there is a significant amount of regulatory activity directly on climate change going on at the moment. The Bank of England is doing the CBES, which is a huge exercise and is going to be taking up a lot of time for members, for ABI members, certainly. So the 10 leading insurers are part of that, but all insurers in the country have to report back on their compliance with SS319 by the end of this year. So that is a huge amount of data gathering, quant and qualitative analysis. So I'd probably say with the regulators, there's a long way to go on climate change, but I think they are showing leadership. I think they are doing quite a lot already, and I think probably saying to insurers, actually, we want regulators to do even more would worry people a lot, because I think the workload is already very high, and I think probably need to understand what the regulators have already done and the exercises they've already started before we jump to the next thing. So yeah, I think that's probably enough from me.
Can I ask a question then, Ben? Actually, I'm going to be naughty and step in.
Yeah, go on.
Is there things that you think that they should prioritise?
So regulators,
resource strapped. Is there a way we can give them more guidance on which we think is more first move?
It's a really good question, actually. I think at the moment, what they're particularly focused on what is quite extensive data gathering, and they are, in a lot of that really focused on actually the financial security of the economy, and going, do we have a systemic risk here that we haven't done enough about? And that's probably the right focus, and that's their core function as a regulator. So I wouldn't suggest that they massively change that. I think where the sector can feed in more, but actually I think is already happening, is as well as the sort of the regulatory kind of compulsory initiatives, there's also the joint climate financial risk forum with the PRA and the FCA, which is a more collaborative, and a lot of that work's kind of industry led, but with regulators sort of shepherding it. And I think actually, to be honest, I think that again, it's not, they've not found all the answers, but it feels to me that they are focused on the right things. And actually they're doing a lot of work. Probably what they need to do is make sure that interesting work that's going on is shared out, so that other people can make sure that they can collaborate and feed it in. But I wouldn't be critical of the regulators' approach, to be honest. I think there's a lot more to do, but I think they have significantly upped the collective game of the industry on climate change in the last couple of years. The level of interest, and obviously some of it's come from the wider political environment and from the media and the more focus on climate change, but a lot of it has been driven by the regulators. So I don't know if that answers the question, but I sort of struggle at the moment, which feels unusual for the ABI, but I struggle to think of anything we could be critical with the regulators on climate change, to be honest. But other than just always recognising that this is a complex subject and it's a lot of work for people.
Okay, interesting. So what I'm going to do is I'm just going to take a pause just from and we can have the next poll, please. Here we go. Next poll. Yeah, there we go. So what does the insurance sector need to use data sharing effectively? Does it need to use data sharing effectively to achieve net zero? So a sector-wide data sharing framework, data sharing regulations, data standards, something else. So any thoughts on that? I'll give you a minute. And just to encourage you again, if you've got any yes, if we've got any questions, we've got loads of things in the chat that are wonderful. Thank you for thank you. Mike Hope has put in, there's several initiatives to provide better ESG information in capital projects. Take a look at Open Built. So lots of suggestions, lots of input into the conversation, which I very much appreciate. Miranda Sharp's put in about digital twin legal roundtables. Digital twin, obviously very interesting topic, but I'm just wondering if anybody has any specific questions they could put in. That would be fantastic, as well as the comments. So thank you very much for that. I'm going to give everybody just another 10 seconds, and then we're gonna move on. Right. Right. So basically the results are fairly across the board, but a real focus on sector-wide data sharing framework and data standards. So So that'd be interesting. I'm going to throw this out to anybody who wants to come in on this around data standards. So this is a question that has, you know, I've thought a lot about since getting involved in SERI. So, you know, what needs to drive data standards? How specific do we need to be? You know, does anyone have any ideas around what that structure might look like? I'm leaving this intentionally open, by the way. Obviously, I've got my own ideas, but I'm leaving it intentionally open to not lead anybody in any direction. So, anybody have any thoughts on that? Anybody want to come in? It's a difficult question, I know. As I say, I've wrestled with it. I'm not going to pick on anybody. If no one has any specific ideas, I've got another question, which I can lump this in. So if you have any thought on data standards, please come in or answer as part of this. But coming back to the EPC ratings, because this is an idea that we've got around commercial properties, you know, this EPC, and I know EPC ratings are imperfect. I know they've got a lot of problems with them, which we can go into, but they're probably the best thing that we have. And what are the thoughts on the idea of if we made them, you know, a bit stringent, we made them, instead of you cannot rent out commercial property unless it's E or an E rating or above, it was D. Would that have any effect, or would that just be whistling in the wind? What do people think the government might think of that? Would that be of interest to them? So anything around EPC ratings, anybody want to come in with? Because now I'll have to start picking on people. If no one will come in. Ted, what do you think about EPC ratings?
Yeah, I mean, it's an interesting point. We've done research on this in looking at domestic houses, to be honest, more than commercial. But yeah. I think there's definitely, you know, if you just go back to basics, you've got a target, net zero target 2050. That means by 2030, we've got to, you know, retrofit millions of homes and millions of commercial buildings. So I think there needs to be some sort of significant shift. And I think just knocking up from E to D is probably a bit of a bold measure. And I think you'd have to put in place, if the government would have to put in place proper sort of funding mechanisms to help businesses do that, because otherwise you just get people in poor quality buildings that are likely to be smaller businesses that are just completely knocked out. So I think that's probably not going to be the immediate answer unless you have some sort of redistribution that fund those businesses to you know, retrofit their buildings. But I do think there's something in that there can be something in shifting the regulation on that. But it's just all about the delivery, I suppose.
Would that, if that wasn't a great way of doing retrofitting, what would you put on what measure would you push on retrofitting?
Well, as you said, we don't have anything better than the EPC at the moment.
Yeah.
So I mean, we need basically these buildings to be C and above, not just D and above. So like, there's a small step into what we need to be doing. I think the measures need to be more drastic. So it's a tricky one as well, because obviously commercial buildings are not the ones that the government think are more important. At the end of the day, people care a lot less if their commercial buildings are drafty. Whereas if you retrofit a domestic holding, it improves people's quality of life. It reduces heating bills for homeowners and tenants. And so, you know, it definitely needs to happen. But I think it's probably not the easy win for the government. There's not that many co-benefits to tackling the efficiency of commercial buildings.
Right. Okay. Thanks for that, Ted. Richard, I'm going to bring you back in. Just really about the building passport itself, and you know, ways we've talked about this, I know offline, but ways that it could be interesting to insurers above and beyond the climate change.
Sure. I always, for this purpose, I always come at this from a commercial perspective. If you're not going to use regulation to make the industry do something, you're in Dale Carnegie territory. You know, the only way to make them do something is you know, they've got to want to do it. So where's the competitive advantage for them in these passports? Well, for some insurers, if depending on contract terms, you could secure a competitive advantage by understanding more about a risk, a building, than the next person. And that's how you would get an insurer to take an interest. They might also take an interest in the aggregate, because I think I told you, one-to-one, that the insurers have had problems in the past where, particularly with windstorm in North America, they've been caught out by the amount of value in property destroyed in hurricanes. So the more they knew about that, the more accurate their risk pricing would become, ergo bigger profits, smaller losses. So that's where the commercial opportunity exists. But it's quite a hard area to get your head around. After all, it doesn't matter what a building's worth. If it's been insured for $100 million and it's wiped out and it turns out that it's $250 million to reinstate it, you're only going to get $100 million. And so the risk was priced on $100 million, and it was the probability of the loss, not the amount of the loss, that determined the risk to the balance sheet. And the probable maximum loss is what the underwriter is looking at, and it's as much an issue of probability as it is sum assured. So it's one factor, and for some types of insurance, I mentioned to you facultative reinsurance, where an insurer offloads one risk amongst a bundle that's insured for a commercial client, a single building, then that passport is going to be pretty interesting, because the question is, why does the insurer want to get rid of that single building? Answer: because it's too expensive for their risk appetite. So if it's too expensive, is it more expensive than they're telling you? And so for that sort of situation, the passport would be extremely valuable to the insurer, but bearing in mind it wouldn't be terribly valuable to the insured or the direct writer, because they're going to have to pay a higher premium to insure it. So these commercial factors are dominant in the market. These are free despite regulatory standards. These are commercial markets, and they're highly competitive. And finding a way through the competitive pressures is what it takes, and that's what drives me back to a regulatory solution. And I hate regulation. I have been a regulator for more than half my working lifetime. Regulation stifles, but the fact is that we have lots of it, and we have lots of it for a reason, because markets don't regulate themselves very well as a rule.
Yes, thank you, Richard. Thank you very much for that. So, Anne, if we can have the final poll, please.
Yes, Nick, it was the final poll.
Oh, that was the final poll.
Yes.
All right, sorry about that. Apologies. Well, thank you very much. Catherine Stevens, Bird and Bird, I was just going to bring you in on your thoughts on any of this, just from your perspective, in terms of the stuff that you do, in terms of the framework and everything we're trying to do on the building passport. Just any thoughts? Again, you feel free to comment on anything that we've gone over. You there, Catherine? No. Okay. Fair enough. I will. So, I guess here's what we're running out of time. We've got 10 minutes. And what I want to try and get to, we've covered a lot. And thank you, everybody. It's been a great session, and I'm really impressed with everything that we've got through. But if really what I'm looking for, right, in all of this, and we've covered so much territory, and there's so much to say about this, but really, if there was one little thing that you could, if you could present to the FCA or the PRA, one thing, just this is the one thing you could do, and it could be something incredibly minor. Again, you know, I talked about CMA, we talked about open banking and competitiveness. I know that the view in the room is competition isn't the angle. So anything that they aren't doing now, and if they could do one thing that they aren't doing now that could push this agenda, what would that be? Anybody with a thought?
Nick, maybe I'd jump in on that.
Sure, great.
Although I'm not sure if this is the FCA or the PRA, so
No,
maybe
no.
I'm maybe or either of them. So maybe going completely off piste.
No, go on.
And this is probably conceptually too draconian.
Okay.
But one place you would definitely get, I'd be interested in Richard's view on this, but particularly, but commercial insurers or indeed commercial line reinsurers interested, is if there was any form of insured or insurable liability for the owner of the building that goes along with the passport's content and structure. So, you know, as you have with pollution, as you have with, you know, general liability, public liability, employee liability, health and safety, you know, is very much driven by all of that. So if there was some component part of the business passport's content and therefore how well you're performing on that, that the owner of the building or its directors and officers could get sued for, then I'm very sure you'd get the insurance industry's attention about that, because that's straight into the pricing of risk, as Richard was discussing.
Right. Okay, interesting.
Shall I respond to Stuart and Nick to your question on how to irritate the regulators? So Stuart, I agree entirely with you. You could almost create a new class of insurance or a subcategory under the D&O, which is, you know, misleading people on actually the risk presented by your building, because that risk is increasing under ESG conditions and under climate change conditions. There's no doubt about that, and that goes, I think, to the thing that the PRA is already focused on. But nonetheless, it is the point of entry, which is that there is the risk of systemic underpricing of risk, both in the medium, short actually to some extent, but particularly medium and long term. Although the insurance is literally a 12-month contract as a rule, there is the risk of systemic underpricing and therefore systemic risk to balance sheets. The balance sheets of the industry are relatively small. The combined balance sheet strength of the reinsurers is $650 billion. And although that sounds like a lot of money, think about the sums assured. What is the total value of the stock of the built environment around the world, and how much of that is insured? And if you look at the global surplus of the direct writers and the reinsurers combined, it is some single digit billions, I think. So there is very considerable risk arising from error. And climate change is a major potential source of error. And that is, in my view, where if I was still a prudential regulator, that's where I would be focusing with general insurer balance sheets, because that's where it can go wrong.
Just a question from Jeremy to you, Richard. What about the transition risk to insurers who own most commercial real estate, who will need to retrofit their investment properties? Is there a risk?
Sorry, I saw that question on the chat just now. Yeah. It's something that I should have said in my introduction. I just finished as on the board of a regulator, prudential and conduct risk regulator, at the end of December. And one of the things I was trying to impress upon my colleagues on the board was that the risk that the insurers had on their balance sheets investments which weren't worth nearly as much as they might think, and that what they needed to do is evaluate the risk of stranded assets and reduction in value of assets and move their balance sheet investments around the dial away from the cash cow industries like oil and mining and extraction, and toward greener investments where the future profits lie. And that's the other side of the coin, which we haven't really discussed this morning because we've been talking about risk pricing. But you're absolutely right. The one lot of insurers hold as assets the liabilities of another lot of insurers. So you do have, you know, quite a complex economic system going on here, which is vulnerable to climate change.
Indeed. Well, with that, what I'm going to do is we're running quickly out of time. What I'm going to do is throw this open to anyone who's spoken so far for any final thoughts, anything that we haven't covered, just any aha moments, anything that that in all that we've covered you can think of. This is my moment where I'm waiting for that. Aha! Well, actually, have we thought about this to suddenly come up? But
Nick,
anyway, yeah.
There's one thing I wanted to throw in, because I think although this is clearly a huge economic problem and it's going to worry actuaries and analysts for a long time to come, one thought that occurred to me is that it's important not to lose sight of, I suppose, the fundamental challenge, if you're talking about EPC ratings in buildings, say, is simply to encourage people to do this work in their buildings that they own. And I wouldn't lose sight of the simpler things that insurers do, which is actually fundamentally they'll be going into buildings, organising repair works and settling claims. And I think sometimes it's easy to look at this from a sort of underwriting lens and an actuarial lens, and not to forget the role as claims handlers. And one point, and I don't think we're ready as a sector to do this now, but hopefully this is something I think that's worth thinking about, is at the point at which someone is having significant work done on their building after making a claim, that feels like the appropriate point to upgrade their building and make sure that they have good energy performance certificate standards. And I think it's about those touch points and decision-making points for customers, and saying, you know, and that might not be something that can be fully settled as part of the claim, but if someone's going into the building anyway to do work, and I think possibly one of the big things for the government is prioritizing this huge challenge that they face. You know, at the moment, it just feels like an almost unquantifiable problem. Actually prioritizing who needs work, what work done when, and I think there's a role for sort of claims there. And those sort of touch points.
I realize that we're running out of, we've come on to actually a big thing, because I've been thinking about.
Sorry, that was a long answer for a quick thought.
No, actually, no, great. Just because I've been thinking about those touch points, you know, of the obvious time to do this is when, but I guess the problem is if you're thinking about I was thinking short-termism of a lot of the insurance industry. You know, someone's kitchen gets flooded, that'd be a great time to flood-proof their kitchen. The problem being is where the incentives lie, because actually, if you know they could switch insurer, you know, next year, why would you spend an extra £2,000-3,000 to do that? I guess so. It's really about how do you get the incentives correct, which I'm still not sure about, I guess.
No, I haven't got the answers to that bit either. But I think that's the challenge.
It is a challenge, no, indeed. Right, so I'm going to leave it there. Thank you very much to everyone who spoke and everybody who commented. All your comments were great. All your questions were great. Thank you, everybody, for taking part. If I could just ask anyone who has spoken, if they can stay on the line for sort of another 5 minutes or so. I mean, that's it. I know you're all busy, and if you can't do it, absolutely no problem. But if anybody can stay on the line for just 5 minutes for just a quick debriefing, that would be fantastic. And to everybody who came, thank you very much. And just to let you know, we're doing another webinar on June 15th, which I believe is a Tuesday. I don't have it in front of me. Anyway, another webinar to go over our findings, really, and get final feedback on that. So if you can join us on June 15th, I believe that's at 10 a.m. as well, and that would be fantastic. But there will be links going out to remind everyone of that. Thank you very much, everybody. Have a good day.